Good morning, traders. It is Tuesday, September 9th, 2014, 8 a.m. Chicago time. Derivatives trading involves substantial risk of loss and is not suitable for all investors. My personal opinions, market data, and recommendations subject to change without notice. Past performance is not indicative of future results. Not much on the news overnight. A little bit of fluff here and there. Overall, the couple of key elements. German finance minister says the ECB has used up most of its instruments. The Russian foreign minister says a ceasefire on the whole being respected in Ukraine. Ukraine preparing troops to strike separatists. There have been some shelling in parts of the disputed area. Shelling of a school, I believe. Van Rompuy confirms that new EU sanctions will come into force in the next few days rather than immediately. Timing leaves room to review new sanctions if required. The Kremlin saying that Poroshenko and Putin spoke on Monday and discussed ways to facilitate Ukraine peace talks. Bank of England's Carney says the BOE rate hike in spring is set for spring 2015, and that is the goal. Don't forget that Apple launches new products today during their media event. Stocks already trading higher. That's it for the news overnight. Today, as far as economic releases at 9 a.m. Central, we have a JOLTS job openings expected at 4711. At 9 o'clock, Fed's Tarullo, voter-leaning Dove, is testifying at the Senate Banking Committee. At 10:30 Central, 4-week bills for $35 billion, and at noon Central, new 3-year note auction, $27 billion. And that's all we have for today. Let's look at the charts, because that is where we play. Okay, charts. So this is what we have for yesterday. Now, yesterday, quick review of yesterday's Trader Bite. Yesterday's Trader Bite basically set the expectation that the market's likely to try to test lower early, chop around, find buyers, and then push through the overnight high of 675 and start working towards 2008.75 and potentially higher. That did not work at all yesterday. It did manage to break higher from 2003, where we were trading while the Trader Bite was going on, to close the POC at 2005.25. It pushed as high as 2006 quarter, just one tick lower than Friday's high, and then it found sellers. Now at about 15 minutes into yesterday's YouTube video for the Trader Bite, you'll see me talking about the second hypothesis, and I did say that 99.25 and 98.50 are likely to be defended by buyers to maintain control of the auction in yesterday's market. And what happened was it pushed through to 99.25, and it took a rotation of 5.5 points up. That was a decent play there, and then when it turned back and it came right back down to 2000, it was clear that the buyers were not ready to maintain an aggressive stance and to continue pushing higher. So from that point on, as the market returned back to 2000, Hypo 2 was coming into play. Hypo 2 expected a test of 99.25, 98.5, and then a chop, and then a breakdown to 94, which is this point of control. You'll see me mention it again 15 minutes into the video. I mentioned this area down here would be the test area based on the HVN here that was created in the composite. So it went to 94, and then it basically drifted up. Pretty decent, not tremendous, but pretty decent delta on the float up, and then the market finished at the mid VWAP IB, it's just a whole lot of mess here. The LVN area, lots going on in this area, and ended up finishing at this 2000 level yesterday. So it's kind of an odd close. I liked the NASDAQ close better. If I show you the NASDAQ here, NASDAQ tested into the prior day's range, went to the value high at 405, 4075. 75 took it out by a tick and then started to float up. The NASDAQ looked like it was setting up for a mid-short, and it held for a little bit. It looked good for a little bit, and then it ended up pushing through to close a little bit higher and out of the prior day's range. So the NASDAQ looks a lot more bullish. Remember, the tech world is anticipating this Big Apple announcement today. So the S&P was definitely a lot weaker, relatively weaker, as it closed into yesterday, the prior day's value area, moving the point of control lower and closing right in the cluster of all these things: LVN, IB low, mid, VWAP, 2000 level, all just a big mess here. So overnight, pretty much a non-event. Overnight, we opened steady right at the point of control and just traded sideways. We now have a weak low double bottom at 96.25. So the overnight's giving us an idea here that the trade has been balanced overall. It's tried both sides, but it has failed to maintain higher prices off the 96.25 to 2003 and has come back. Looks to me like the overnight low is weak. So we'll see what happens here. We have a close from yesterday above us at 2025. So I'm looking for a potential responsive buying back up on the open, and then eventually I'd look for this 96.25 break. Looks like the market hopping in the short term. So what we have here is this is a 15-minute. What we have here is a point of control that moved from the 95.50, 95.75 up to 98.50, back down, and it basically balanced here these few days. These days are all balanced days to form a nice heavy point of control, composite point of control. Let's look at that on a different. So if we look at this profile, you can see that the point of control is right here. You can see that it's traded quite a bit here between about 2002 to about 94 or so. There's a lot of trading that's happening here. The value area for this is 202.50 down to 93.50, and that's basically where we're stuck. So what we've done over the last couple of days is we've put a high on Thursday of 2010, an all-time high with a point of control and a weak top, a weak high, still holding here for 2 days now, which is unusual. And then it moved the point of control lower on Friday, and it moved the point of control lower today. So the market's forming a top, and the value is dropping with price. Okay, so today 96.25, expecting that to expand down. That's actually probably going to do it right now before the open. It leaves us with a weak 94 and potential test down to 93.50 and then 92 and so on and so forth. So my main trading idea for the day is for this to find a responsive buyer back towards 2000, and then for sellers to step back in and start to explore down to 91.50, this 91.50 area. If 91.50 does not find buyers as it has been, then we're likely to push through to 86, take out the 88 quarter low, and push through to 86 to close this point of control down here. That's the primary expectation for today. If it surprises us and it tests lower and it finds buyers, then it's likely to push back up through, and then again 2008.75 becomes the main target above, and then above there we have that week high at 2010 and new highs for 2013.50 as the target. Is that a lot of numbers? Probably. But today I'm going to sit on my hands at the open. I'm going to watch to see who comes in at the open and how the market reacts. I want to change the subject here a little bit. I got a question yesterday that I see a lot through the weekly webinars I do at Stage 5, and it's a question about, well, you know, you said something about 99.25 and it seemed to go right to it and bounce up. I mean, the bounce happened so fast I could not be a part of it. So what is the point of giving these levels out if they're not going to be easy to trade? And the answer to that is that there is no level that's easy to trade. Trading is simple. It's not easy because trading requires you to go against a lot of training that you've had through a lifetime of studying to guarantee studying to have a guaranteed outcome. In trading, there is no guaranteed outcome. Every single trade's outcome is unknown and unknowable. I don't care who you are. There's no way to tell where in the data set the losses are going to turn up. Even if you have a 99% probability on a closed data set, the market's in an infinite data set, and there's just no way to know where's that 1 out of 100 trade. Does it happen at the very beginning, in the middle, a third, a quarter of the way, halfway, 3/4 of the way, 2/3 of the way, or at the end? You don't know where that loser is going to be. And so the only thing you can do is watch for a reaction. So my method of trading these levels is to look for patterns that show me that the market's unable to take on a level. The levels that I discuss are not areas where you're expected. They're not trade recommendations, so they're not areas you're expected to put a bid and wait for the market to hit that bid and start driving away. That is not the anticipated reaction. That is not how I trade. I don't work a whole bunch of orders in the market. It's important for me to see how the market's reacting. If I'm looking for a mid-short here from yesterday against 99.25 mid at 2025 and VWAP up here to 2050, given the spread that's in between them, about a point and a quarter, I'm going to wait for the market to create a formation that tells me it is no longer able to push higher and is starting to roll over before I get in. That is called price risk to an extent. So the two levels of risk are price and information risk. If you take price risk, you're getting more. You're basically trading away price to get more information, but your price is going to be worse. If you take information risk, you're jumping on a better price, but you don't have more information to confirm or deny your bias. And your job as a trader, depending on the area that you're trading, is to balance those two. Think of it as a needle that has two extremes, either the best price or the best information. The best information has already happened, and the price is gone. And your job is to, depending on the context of the trade, your job is to find a spot for that needle. Do I want to take a better price and risk not having enough confirmation, or do I wait for confirmation, which means I'm going to wait for a moving average crossover or a stochastic crossover, whatever it is you use? But to get that information and to wait for that information, I'm going to take a lot more price risk, driving my stop much, much further, which means I have to cut my size a lot. So those are the things that we have to balance as traders. As I said, trading is simple. It's simple. It is not easy. It is an auction. It's a simple auction. It can be described using a peanut butter jar or an iPad or whatever. The price or the valuation of that product is what we're trading. And in this situation, we're trading the valuation of the S&P 500 index. And so, with that being said, don't it's not suggested that you say, oh, well, yeah, well, he mentioned 99 and a quarter. Let me work 99 and a quarter. Oh, shucks, it only traded 58 there and it ran off, so let me chase it. That's not the intent. The intent is I'm going to be paying attention as the market comes into 99 and a quarter down to 98.50 yesterday. I'm going to pay attention and I'm going to look for the market for buyers to step in or for the market to start failing to push lower, to auction lower. The market auctions lower to find buyers. If I see evidence of buyers, either through absorption or many other things, you can use a Jigsaw trading tool as a product. For example, that's a product that helps you see what changes have taken place in the depth and what is being absorbed and what's not. That's a fantastic tool for that. There are many products like that out there that help you do that. Or I use the naked eye looking at the dome and seeing how the product reacts, but that takes a lot of practice because I started my career as a scalper, as a dome scalper. So I wanted to bring that up and make that point. I won't dwell on it too long, but the intent of these videos is to provide market logic, to provide you with something you can build a substantial plan and a hypotheses for on the day, or to review your own plan for the day. I want to drive home, I've been doing this since 2009 now that I've been out in the public talking about what I do as a trader. The whole point is to show you that you don't need to go out and buy someone's system, that it's all here. The information is already here. All you have to do is stay very close to the auction. Keep your ear to the ground when it comes to the auction and look at the areas that the market's trying to test and how it reacts in those areas, and follow the story. When you follow the story, that does not create a trading system. What it does is it creates a good, strong bias from which to trade, because you have the evidence for what the market is doing. Now you need to look at your risk plan, your trading plan, and how you're going to manage the trades in order to make this a profitable venture for yourself, rather than trusting someone else's system, which may or may not work, and which you have to pay more to upgrade to the updated system or whatever. You need to come up with your own trading plan. In the end, this is about human beings making decisions on value, and it's about machines executing those decisions, and then other machines seeing the execution and executing based on that primary execution. So overall, this auction is being controlled by what traders are seeing as value or not value. And there are many, many techniques to use to determine what that is. Volume profiling is one of them. In addition to the some of the things that I've shared, like the overnight statistics, the way it makes tops, the way it makes bottoms, and so on and so forth. The formations it creates, where the high volume nodes are, where the low volume nodes are. Those are all little clues. The opening swing when it opens, where it opens, what kind of an opening it is, how the delta is reacting on the open, on and on and on. Anyway, if you need more information about that, I've got a billion chat sessions, it seems, on my blog. It's futurestrader71.com. You can just go on there, and if you need further help, just hit the contact button, and I'll try to help you if I can. Take care. Good luck.